Hey, I'm back, guys, and today's term of the day is asset allocation. I've been putting together words that I think investment professionals, investors, even people that want to invest, business owners, entrepreneurs should really know. I remember the first time I learned a few of these words. They were game changing to me a lot of times to understand my position in business, my position as an entrepreneur, and definitely my position in investing, according for today's word. And today's word, compound words, is asset allocation. Asset allocation. So I'm going to give you the definition, and then I'll give you a little freestyle of how it pertains to investing and maybe your business or your businesses, but definitely your investment. So asset allocation, the process by which you choose what proportion of your portfolio you'd like to dedicate to various asset classes based on your goals, personal risk tolerance, and time horizon. Stocks, bonds, and cash or cash alternatives make up the three major types of asset classes. And I would like to add real estate in there as well. This definition doesn't have that in there. Each of them reacts differently in different market cycles and economic conditions. That's the whole point of asset allocation, right? So stocks, for instance, have the potential to provide growth over time, but may also be more volatile. So you'll see during an economic crisis or even during the last coronavirus pandemic, you saw the stock market crash. It slowly but surely has been coming back up, but they're more volatile. Right. Meanwhile, bonds tend to have a slower growth, but they're generally perceived to have less risk. So they usually fluctuate less. In some ways, they don't fluctuate at all, depending on what kind of bond you bought. A common investment strategy is to diversify your portfolio across multiple asset classes in order to spread out your risk while taking advantage of growth. Okay, so again, the term here is asset allocation. So I'll give you an example. I'm 38 years old today. I feel like I have another 40 years of life in me. I'm going to be diversified differently than someone, let's say 65, 70 that just retired, right? You don't want a lot of volatility in your portfolio. You may want to be more bond heavy than stock heavy. You may want to be more cash heavy than stock heavy. You definitely want to be more bond and cash heavy than stock heavy if you're ready to retire. You definitely want more fixed income products like bonds. And as opposed to stocks. So whereas me, I may want to be maybe 70% in stocks and 30% or 20% in bonds and 10% in cash, right? Because I have a longer time horizon. I'm still working. I still have income coming in. Now, I like to look at asset allocation, or sometimes I call this your investment allocation, right? Where are you investing your money? Where are you investing your assets? So in America, a large portion of people's asset is tied up in their home. A lot of people have $150,000 home and a small savings and an even smaller stock portfolio, right? I was having a conversation with an entrepreneur the other day, a great colleague of mine, client of mine, and we were talking about asset allocation. So if you have, let's say you say, you have 50,000 in the stock market, and you say I have 50,000 in savings. You don't have 50,000 in savings. You have 50,000 in the stock market, which is different, right? You want to spread it out. So, for example, if you have a little bit in the stock market, you have a little bit in bonds, you have a little bit in gold, maybe, you have a little bit in cash, you got a little bit in real estate. And then in those allocations, you can break them down further. So, for example, in stocks, if you have 50,000 in stocks, you may want some consumer discretionary items. You may want some technology. So let's say you have 50,000 in stocks, but the only stocks you have are Facebook, Amazon, Google, and Netflix, right? Great companies, by the way. This is not a discussion of how great those companies are, whether they'll go up or down at any given time. But the point is, you're tech heavy. Your asset allocation in stock is by sector is all tech. So if the tech sector crashes for some reason, let's say there's a virus that hits the internet, from another country, attacks another country and takes down, a whole bunch of sites on the internet. Well, that stock market is going to crash in the tech sector, whereas the consumer discretionary items, let's say Procter & Gamble, Unilever, people that sell toothpaste, soap, maybe McDonald's, right, is not going to crash the same way. Same thing in this coronavirus pandemic, right? There were some businesses that were mandated to close. So if you had a movie theater stock, that thing got crushed, or a Carnival Cruises or Norwegian Cruise Lines, the cruise ships, they got crushed, right? That was a travel and leisure sector. That sector got crushed. So even within your asset allocation of stocks, you want to be diversified. Same thing, let's say if you have real estate. If you have real estate, like I own some land, I own some buildings, I own some tax deeds, right? There's different ways to diversify even once you diversify your total asset allocation. But the goal of understanding here is to understand asset allocation in general, right? So when you're investing, when you're every dollar that you pay out, there's only two things that happen. You either spend it or you're investing it, right? There's only two ways, or you save it. Saving it is really a deferment because you're either going to invest it or spend it, right? So if you're saving it, there's only two things you're going to end up doing with it. When you invest it, you want to make sure you're diversified enough that you protect yourself. Now, we can have a whole nother discussion of when not to diversify or when to diversify. Most people say diversify for safety. And if you want to get really high returns, do not diversify. But you want to know exactly what you're doing when you don't diversify. So if you're really good at something and you understand a certain area really well and you can get a high rate of return on your capital there, it may be better to not diversify. But in general, you want to diversify, and you want to diversify across asset classes. So stocks, cash, bonds, real estate. These are different asset classes. Now, understand the difference between an appreciating asset, depreciating asset. We'll get into some of these keywords later, but generally your house is a savings account. You're not making any money there. You just keep putting money back in, back in, back in, back in. It's an equity play. You're hoping that that's worth more one day, and if you're never going to sell it, then it's really nothing. So again, diversify asset allocation. Think about your asset allocation across various sectors. I'm going to put in a bonus sector for assets. It's a business, your actual business. So, for example, I have an entrepreneur who has stocks, the same guy I was talking to before, right? He has stocks, he has bonds, he has cash, he has real estate and land and buildings, right? But then when you look at the return on the stock market, maybe 7 to 10% over the next 10 years if you leave it in. That's a long-term investment. Stocks usually are a long-term investment. Bonds a little bit lower because they're safer. So you're talking about 3 to 5%. At the bank, they're like 1%, less than 1%. But if you go with corporate bonds, like if you buy a Microsoft bond or an eBay bond, you can generally find them between 3 and 5%, sometimes 6% when the markets are good. Real estate, right? If you look at the cap rate on real estate, really high risky real estate, you're talking about 20%. Safe real estate is under 7%. In some parts of the country where it's really expensive, like New York City or Miami, you're talking about 3%, 4%, 5% returns on your real estate. But then you start a business, right? Let's say you start a pizza shop, and every time you dump $1,000 into advertising on that pizza shop, it brings you back $5,000 a month, right? That's a hell of a return. That's a 500% return. So if you're young and you're thinking about diversifying your asset classes and you own a business, think about that. Put that into the mix with your asset classes, because it could very well be that that's one of the places where you want to diversify your money. But that's the term of the day, asset allocation. Think about it. And then in each sector, when you're talking about stocks or bonds, diversify there as well, right? You don't just want to buy all bonds from one bank or all bonds from one company. You want to diversify the bonds there. You want to have a different allocation. Same thing with the stocks. You don't want to be sector, agnostic. You want to make sure that you can diversify the sectors here, maybe some in energy, some in tech, some in consumer goods, some in banking and finance, right? Diversify. Same thing with real estate, right? If you have all your real estate in one market or all in one house, well, then it's a little bit riskier, right? That's the point. So asset allocation is the term of the day. If this was helpful for anybody, like the video, subscribe to the page if you want to see more, share it if you think somebody else will take some value out of this video, and I'll be back soon with some more videos.